credit report, as well as look up your FICO score through tools like Credit Karma or freeannualcreditreport.com. So I've got the links in here for you. But knowing what they are, being able to explain any negative remarks, or being current or not having any delinquencies is going to be key. Not just for you, but also for anybody who owns 20% or more of the business. That's going to be considered a principal. You'll hear me say that throughout our talk today, 20% or more, because that's now a principal or an important person that's in that business or owns it. Now, lenders will all have different credit scoring criteria, what's good, what they can do with, top and bottom numbers. Some lenders don't even use FICO scores. They just go based on bank records. So talk to your lender, be upfront with them, know what your credit score is. And well, it's an important area that sometimes you need to spend some time to clean up. But a lot of business owners, I should say, ask me, hey, Sean, if I'm getting a loan in the name of the business, like it's an LLC or a corporation, why are they asking me for my personal credit report? And that's because, well, there's such a close relationship between the business owners and the entity or the business itself. And really, when you go applying for a business loan, the bank is going to be evaluating, yes, the business, but also the owners and the holistic, picture that represents. Because oftentimes for an SBA loan, they're going to have you sign a personal guarantee, which kind of hops right over that liability limitation offered by a corporation or an LLC. So that if the business can't pay the loan back, well, now you personally are guaranteeing to pay that back. So they're going to look at your business as well as you, the owner. So that's important to know, and a common question that we get. But as we talk about our personal financial situation, we have this form called a personal financial statement. And I'll be honest, and when I first filled one of these out, it's a little intimidating, fine print and a lot of places to put numbers. But really all this personal financial statement does is it takes all of our assets that we own personally, not through the business. This is a personal financial statement, and I want to emphasize the word personal. But it's going to add up all our assets, and it's going to subtract our liabilities, and hopefully we have a positive net worth there. So for example, let's say you owned a home for $1 million. You might put that as an asset based on real estate, based on like Zillow or Redfin kind of valuation. And then let's say you owe 500,000. So we're going to have a mortgage here. So that's the liability. So we would have a net worth of 500,000. Now, it's a little intimidating to fill out this form if you're doing it for the first time or you haven't done it in a while. Because there's a lot of accounts you have to log into in terms of, okay, gotta go look up your savings, and your checking and all these different passwords from your retirement and so forth. So to speed things up, I usually recommend folks when they're filling out this form, just pull your credit report. That's why I had that as number 2, because it's going to give you all your current balances and you're going to look and go, oh, wow, we still owe that much on the house. It's been a long time we've been paying this off. So that can speed up the process because you're going to want to do this usually as of like 45 days or sometime current. But it's a good exercise to go through. It can be a confidence builder when you're walking in and talking to a lender, kind of going, yeah, I have some net worth here. Might not be, the rich among the richest, but I've got something to work with, and I can show a bank or an investor that, hey, yeah, I have some personal liquidity and financial stability. That's really what they're looking for here. And even on page 2 of this form, which I've got some links here to take you to some of those downloadable forms because they do update them. But page 2 has got things like property, so rental properties or primary residence. So bank, this will give insights to the lender of like, okay, down the road, when we get to the collateral conversation, if there isn't enough collateral in the business, we could see some assets here that could be pledged. But it's an intimidating exercise. I've got a little video here also from YouTube because even things like life insurance kind of trip me up as you're filling it out. That can be helpful. But this is going to be something also anybody who's involved in the business that owns 20% or more. So let's go ahead and get back to that. Next is number 4 is tax returns. Your tax returns are going to be an important document for a lender to help determine that capacity C that we saw in the 5 C's of credit. How can we repay this loan? So they're going to look initially to the business tax returns. And here on the screen, I've got like a 1065 for a partnership, an 1120S for an S Corp, or a Schedule C for like a sole proprietorship or a single member LLC. But they're going to look to the business tax returns and that ordinary business income, profit, or loss. And they're going to want to see 3 years of business tax returns and 3 years of personal. Again, they're looking at not only the business, but also the owners and the financial stability of both. So we're going to see how they're going to calculate this ratio to see how we can pay back this loan or prove that we're able to without putting the business in a financial hardship. But the 3 year thing, usually they're going to want to see your business be in business for at least 3 years. Ideally, different lenders have different requirements. Sometimes you only need to be in business for 1 year or 12 months. But others may say I need 3 years. And so talking with your lender about, okay, what are the eligibility criteria for, years in business? And does that need to be represented on a tax return? But this is a really important document that most banks will initially hit you with. And that's why we're kind of doing this webinar, to be able to give you the full laundry list. Because if you're like me, I like to just go get all my documents and have it all ready, rather than kind of give me some now, give me some more, etc. But 3 years personal, 3 years business, as it applies to your business. And well, they will have you sign off on this form called a 4506T, which is basically just giving the bank permission to pull your tax returns, or what they call your transcripts, directly from the IRS, because they're going to trust you, but they're going to verify that you haven't changed the new numbers on that PDF that's so easy to do these days. So that's a common form. Next up is a debt schedule, which is going to essentially list out all of the current debts the business has. You can see it's a pretty straightforward chart here. The name of the creditor, the original amount, the date it was taken out, if there's a current balance, whether you're current or delinquent, the maturity date, if there is one, and the minimum monthly payment. I want to emphasize minimum, because sometimes we may be paying our bills and we just allocate a certain amount of money towards the credit card, but the minimum payment is different. Here we want to list our minimum payment, because we're going to use that number when we add them all up to calculate the ratio I talked about. But it also asks how it was secured. So this will also give the lender an insight into other financial institutions that may have a vested interest in the business, in terms of what assets may be being financed. But it's a pretty straightforward document. But again, looking up those balances, going, okay, as of this day, again, we want to keep it within 45 days, so pretty current. This is kind of where things sit in terms of our liabilities. They'll also ask you for like a balance sheet, and that should probably coincide pretty closely. But with those two things, the tax return and the debt schedule, we can now do calculate what's called a debt service coverage ratio. And I'll show you a quick example to show you how it works. But this is where we prove to the bank that we can afford this loan that we're asking for. And so in a quick example, let's say based on our tax returns, we had a net income of $42,000. Woohoo! We're making, this is after expenses. So gross, your income minus expenses, we have $42,000 of net income that we pay tax on. And then let's say we had some expenses for things like depreciation and interest of totaling up $12,000. We're going to add those back into our net income to increase it, because depreciation is a non-cash expense and interest is going to come out in our second step. But right now we're saying we have an earnings before interest, taxes, and amortization of $54,000. Now, the second step is the debt. This is where the debt schedule comes into play. And we're going to list, based on the debt schedule, let's say we had $1,200 a month that we pay in our current debt. Now we're asking for a loan of $150,000 at 9% over 7 years, and that will calculate us a monthly payment of $2,413. And if we add, or we have to multiply these by 12, because these are monthly and this is annual, this earnings. So we got to multiply it by 12 to get an annual figure for our total debt service of $43,356. And then all we have to do is divide the two. And we have a debt service coverage ratio of 1.25, which is essentially saying we have $1.25 in earnings for every dollar of debt the company has, and including what we're proposing. So I've done the numbers specifically this way to get to 1.25, because that's usually the place you want to be. There are lenders that will go lower than 1.25, but basically the lower you go, the more you're saying you're kind of, the more leveraged you are. So 1.25 or higher, good. 1.25 or lower, it's going to be now you're a little weaker. And that's where the 5 C's of credit. You might be strong in one, two, or three categories, but there might be an area that you're weak on. So we're going to put together this story for the lender. And this is kind of how a real example of what they'll do with your tax return and a debt schedule. But other documents that we may need to get together would be like a schedule of collateral. And this is just a schedule that lists out all the pledged assets that you're going to use to secure the loan. Essentially, the bank wants to see some skin in the game and your commitment to repaying this loan. And it can be from assets from both business and personal. But I want to point out that they aren't going to just give you top dollar, so to speak. So here on the screen, I've got a discount schedule. And this is just for example purposes, but let's say we were getting a loan and we were going to get $100,000 in inventory. So that would be the fair market value because that's where we're going to buy it at. There would be, there would be no liens because, well, that's what we're getting a loan for. But they're only going to give us 35% or 35 cents on the dollar for that that particular asset. So really that's $35,000 and we have to come up with the difference elsewhere. So that's where I say a lot of businesses won't necessarily have a ton of collateral in their business. If they do, great. But that's where you may have to reach into the guarantor's pledged assets or personal assets, I should say. And you might have to put up, your home to secure the loan. And they're not just going to give you 80% of your home's value based on Zillow. Well, they're going to give you your home's value minus whatever you owe the bank, that lendable equity portion up to 80%, possibly. So it's important to think about collateral as you're working through the loan process. Different loan amounts will dictate different collateral requirements. For example, a microloan of 50,000, they might just ask for a pink slip on your car. But this is an important conversation to have, and no one really wants to have that conversation. Like, what if it doesn't work out? But as they say, plan for the worst and hope for the best, so that we're prepared. And this is just kind of one of those things that you want to talk about with your lender in terms of collateral requirements. As we move on, this may or may not apply, but an accounts receivable or accounts payable certification, if your business does receive terms from vendors or provide terms to customers, the bank is going to be essentially looking for an aging of accounts receivable and accounts payable. The accounts receivable is going to give some insight to your lender in terms of, well, your cash flow needs, as well as your collection efforts. Because if you've got a bunch in past due and over 90, I'm going to go, why don't we work on getting that money before borrowing more? But it's going to give some insight to your lender in terms of how your business is running. Receivables sometimes can be used as a form of collateral. So talk to them about that if this does apply to you. And then on the payable side, it's really good for a lender to see that others are willing to give your business terms, and it shows kind of a reliability standpoint and it can help improve your position. Like, oh, other people are willing to lend you credit. It looks good, I'll just say. But if it doesn't apply to you, you could just check this box or something similar that says we don't offer or carry any accounts receivable or terms. Next up at number 8, we have licenses, permits, and entity formation documents. This is going to be important to a lender because they want to make sure the business is operational and legally set up. So, making sure you're in good standing with the state of California if you have an LLC or a corporation. But the documents like your bylaws and stuff like that, sometimes they may request. But for my startups that may be watching, it's important to know that you're going to want to have all your licenses and permits kind of in hand for the most part, because, well, the bank doesn't want to give you money, and then, there may be some authority out there that can, prevent you from operating the business, which then prevents you from being able to pay them back. So having all your licenses and permits in an organized fashion and available for them is going to be really important. Number 9 is probably where the SBDC can help you the most, and that's usually when it comes to business plans and financial projections. Not always required by the lender, but when it is, it's kind of a head scratcher. Like, hey, where do I start to create a business plan? Because I'm often reminded of my mother's favorite saying is, Sean, my plan is simple. It's to make money. Why do I have to write it down? So sometimes an investor or a bank will ask you to write it down, And they want to see really not only a pretty format of, month over month cash flow or income statement, but really what they want to see is an organized plan financially, primarily, that lists out your revenue assumptions and your expense assumptions that are realistic. And that's where the SBDC, we offer free one-on-one consulting to help you develop a business plan, but also start and grow your business. And you can take advantage of our free consulting by signing up to become a client, and we set you up with a either in-person or online meeting via Zoom. But if you're one of those persons that wants to just do it themselves, we have a great on-demand training and access to a website that we've created to help make business plans a little less painful. But they are an important aspect. It goes a little bit above and beyond that first thing that I mentioned, that history of the business and funding sought kind of synopsis. This is more of a detailed plan financially that says, yes, this is how much we need, this is what we're going to use it for, and this is how we project to pay you back based on these solid revenue assumptions and these solid expenses assumptions. And if you're an established business, you got something to work with, great. If you're a startup and you need to kind of pull together some assumptions, that's where we can help you out. So, but just think about it, like you're asking me for a loan or a friend or family member, you would go, well, how are you going to pay me back? And how are you sure? Because I don't want to put you in a hardship. A good lender doesn't want that either. So a good business plan can definitely bolster your loan application. Next up is at number 10, we have management resumes. And it's kind of funny when I tell a lot of small business owners that to update their resume, not to get a job, but to get a loan. And the reason being is that investors always say it, I bet on the jockey more than the horse, meaning they want to invest in businesses that are run by skilled individuals and teams rather than newbies kind of learning as they go. And your loan application is going to be sitting in front of a variety of people, quite honestly. And they're going to be looking at a lot of things. But one of the things I hone in on is your experience in the industry to do what you need to do to make this business successful. And yes, you can fill out their form and do so, of course. But I would add a nice resume that's been updated to really reflect the experience that you have in the industry. And it's kind of weird sometimes because maybe you've been in the industry for 20 years and you've never had a resume. Well, now there's a lot of resume building tools, whether it be Canva or online, to really take some time to explain to someone who doesn't know you why they should invest in your business. Yeah, you might have some profitability on your tax returns and have a great credit score to show your history of repaying others, but who are you? Like, I want to really know that I'm investing in a good, solid business run by a good owner or team of individuals. So don't mean to get on my high horse so much on this one, but and this also applies to any key personnel in the business, but also anybody who owns 20% or more. They're going to want to know who owns the business, who's running it, etc. So kind of a weird one. Next up at number 11, we have lease and subordination. So if your business involves a storefront that leases a location, the lender is going to want to see the term of your loan coincide with the term of your lease. And I'll give you an example. Let's say you're getting a loan over 7 years. They're going to want to see, the lender is going to want to see that you have permission to stay in that premises for that term because it's so critical to your business. So what that might look like is a 3-year lease with 2 3-year option periods or something along those lines. Because, well, if you have to move, that's going to be a disruption to the business. And so for my startups that are watching today, I wouldn't recommend signing a lease. I would probably suggest you get a letter of intent and then work with that letter of intent and your finance or your lender if you're talking about starting up a brand new business. We don't want you to sign a lease and then not be able to qualify for the funding. And then the last thing I mentioned on the lease is going to be the subordination agreement that the lender is going to have your landlord signs, essentially saying that they can gain access to the unit to recoup any collateral if the loan does go sideways. So it's pretty common, but that's important to think about depending on your lease situation. It may or may not apply. Another area is going to be insurance, and it may be pretty, simple. Like if you're buying a property, you need to have property insurance. If it's in a flood area, might have to have flood insurance. But the one that kind of gets folks is when the business is heavily reliant on one of the owners' continued involvement. They may ask for a life insurance policy of a certain amount. In addition to other things like, workers' compensation if you have, employees. So, but they may need to be listed as an additional, or what is it called, a loan loss payee. So that gives the insurance company the ability to pay out the bank directly, or maybe even be listed as additionally insured on your insurance, which gives them basically legal protection should they potentially be named in any kind of lawsuit related to your business. So insurance is going to be good. Get your Accord forms that list out all your insurance and depending on the different types of policies that you have. And talk to them like, hey, do I need to get life insurance? That's going to be important. Number 13 is identification. They need to know you are who you say you are. For SBA loans specifically, you need to be a citizen, a U.S. national, or what do they call it? A green card holder or a legal permanent residency. Um, and every loan program is going to be different. So I'm talking that was specific to SBA, but just know that these rules can change and different eligibility requirements are for different lenders. You might be working with a nonprofit community lender versus, a big bank or something like that. So talk to them in case you don't fit into one of their buckets. And know that they change. Like SBA loans, it used to be it had to be owned by the business, had to be owned 51% or majority owned by a citizen, a lawful permanent resident, or a U.S. national. Now it's 100%. So these do get updated from time to time. And also along the lines of the borrowers is this form that SBA calls a 1919 borrower information form. It's got a lot of questions, and really they speak to a lot of different areas, from criminal offenses to whether your business is a franchise or perhaps you're even a son or daughter of a sitting congressperson. So not to say that any one answer to these is going to preclude you from getting an SBA loan, but it will, excuse me, it will usually trigger additional reviews or approval processes. So keep that in mind and do talk to your lender about your particular situation. And last but not least, I know we went fast, but is this miscellaneous document. So interim financial statements is going to be something important to a lender because your tax returns may have been filed from, that data, those numbers may be a little bit old. They might go, how are we doing this year? You may need a loan application form. Sometimes there's fees associated with those, etc. So talk to your lender, but we've hit on the majority of the most common requested documents as you seek to get a small business loan. So that's where I said at the beginning, we have this loan package checklist that you can scan with your phone, and we will send out a follow-up with this link. But it's a document that basically goes over in written form what we've just covered today in slideshow format. But it's a good document because I think first and foremost, when you're seeking a small business loan, it's about being organized in your approach. And this will help you have all these documents ready, whether they're in hard, like a binder, also have them in a soft copy, like a little thumb drive, because a lot of times these days it's all uploading the documents via a secure portal. But having them ready, reviewing them yourself as a business owner is going to be important as you start this process. But what we want you to know is that you're not alone. This can be a daunting process, and there's going to be some strengths and some weaknesses. And depending on the dollar amount that you're looking for your business, that's where SBDC offers free one-on-one consulting. Because I know there's probably a lot of questions out there. And rather than get into the nitty-gritty of, okay, my FICO score is this, my debt service coverage ratio is that, or I have losses last year, that's where you can meet with a consultant to say, okay, how can we tell the story? What is the likelihood of me getting any funding approval? And if the answer is yay, great, or yes, if the answer is no, okay, what are the options? So that's where the SBDC really comes in and provides that kind of sounding board and advice for you as a business owner. We don't give out the loans, but we can help you through the process. So without further ado, I'll just say thank you so much for joining us on our Loan Package Essentials conversation today. And if you need any help, feel free to give us a call or sign up as a client. But thanks for joining us, and we hope to see you next time. Until then.